Welcome to the Deep Dive. We are Talk Tickers.
And today we're digging into the fiscal fourth quarter 2025 earnings call for LAR.
Right, one of the nation's absolute housing titans. And our mission today is pretty simple. Take all that dense data.
All the conflicting signals from the call.
And just distill what you actually need to know.
The report itself dropped after market close on December 16th, and then you had the management call the next day.
And it was, a really confusing narrative that unfolded. It was this high-stakes story.
You had this fantastic operational performance on one hand, a machine running at peak efficiency.
But then, paradoxically, that led to a significant, significant, margin collapse.
So it was this revenue beat that was just completely overshadowed by a really painful profitability miss.
And a very cautious look forward.
That tension really defined the entire print, and the market, well, it recognized it instantly.
Yeah, the stock pulled back, about 4.5% during the call?
It did, which really confirms where investor priorities are right now. It's profitability, not just volume.
Okay, so let's break down that financial snapshot.
Well, let's start with the top line, which, proved pretty resilient in a tough environment. Revenue came in at $9.37 billion.
Which was a beat, right?
A comfortable beat. Consensus was looking for about $9.02 billion. So that's real sales execution right there.
But we should note, that's still a year-over-year decline.
It is, down 5.8%. So volume held up in a difficult market, but it wasn't growing.
Okay, so volume held up, but then we get to the profitability, and it feels like the wheels just fell off.
That's a perfect way to put it. Adjusted earnings per share, it landed at $2.03.
And the street was expecting, what, $2.21?
Exactly. So that's a big 8.1% miss. But to really get the stock reaction, you have to look past EPS and go right to the main driver.
Gross margin.
Gross margin. Home sales gross margin compressed dramatically. It plummeted to 17.0%.
17%. That's the number, right? That is the most important number in this entire report.
But it's the whole story.
Just 12 months ago, they were running margins at, 22.1%?
22.1%. That 5.1 percentage point drop is just staggering.
So it immediately raises the question, why? Why did management accept this kind of hit?
And their core thesis was laid out pretty explicitly on the call. They said they prioritized volume, pace, and market share.
Above all else.
Above everything. They called the environment stubbornly difficult. Affordability issues, weak consumer confidence.
And there was that external shock this quarter, too.
Right. And so to maintain their sales pace, that target of about 4 homes per community per month, they paid for it. They paid for those sales with deep incentive.
Which sounds like a huge bet against the macro environment. If rates stabilize or drop, they could win huge market share.
They could.
But if rates stay high for another year, is this strategy, paying these deep discounts, is that even sustainable?
That is the absolute central strategic risk, and the cost of that volume was immense.
How much are we talking?
Management actually quantified it. The average sales price was $386,000, and that carried about 14% in incentives and price adjustment.
14%.
14%. And you have to compare that to their own stated normalization range.
Which is usually, 4 to 6%?
Exactly. They say in a healthy market, incentives run between 4 and 6%. So right now, they are paying roughly 3 times their normal subsidy just to keep the customers signing those contracts.
But the flip side of that argument, and this is the one management is trying so hard to push.
Desperately trying to push.
Is that they aren't just giving away houses, they are optimizing the machine itself. They're building this world-class production line.
Yeah.
And they're just waiting for the external environment to let the margins flow through.
Absolutely. And the operational throughput metrics, you have to admit, they are legitimately stellar.
Okay.
And that's the reason why the long-term bulls still have that conviction. They're taking a short-term hit on incentives, but the efficiency gains, those look structural and lasting.
So give us an example.
Okay. Look at cycle times. For a detached single-family home, they got the build time down to 127 days. That is an 8% year-over-year reduction. Think about that in terms of capital velocity. Build a home faster, you start the next one sooner.
Exactly. This is that manufacturing model in action. It's turning home building from, a construction project into a scalable assembly line. And that speed,
it translates directly into cash flow efficiency,
which leads to better inventory management.
It leads directly to it. Their inventory turn improved significantly to 2.2 times. That's up sharply from 1.6 times last year. That's just money moving faster.
And they're controlling costs, too.
They are. They reported that direct construction costs actually decreased by about 5% year over year. So their national purchasing power, their standardized plans, It's all working.
Okay, so we have a perfectly running, fast, efficient factory, but they're selling the product at a big discount.
Right.
That brings us to their other big strategic move, the asset-light transition. How did that look this quarter?
It's largely complete, and it is so critical to their long-term resilience. The whole goal was to get land off their balance sheet, free up massive amounts of capital.
And they did it.
They succeeded. Less than 5% of their land is now on the balance sheet. Instead, they control 98% of their home sites through land banks and partners.
So what does that mean in practice?
It means they have massive optionality. They can turn the faucet on or off depending on the market, all without the capital drag of owning the land outright.
And the balance sheet reflects that.
Big time. They ended the quarter with $3.4 billion in home building cash and a fortress-like debt-to-capital ratio of just 15.7%.
That's their defensive moat.
Exactly.
We also saw some corporate housekeeping with that Milrose split off. It resulted in a $156 million loss. Now, for the average investor, that sounds like a massive hit.
It does sound alarming, but it was purely a non-cash transaction. It was a bookkeeping correction.
So just paper moving around.
Think of it this way. They basically swapped one asset, the Milrose shares, for their own stock to simplify the company. The $156 million is just the accounting difference between the book value of what they swapped and the market price of the shares they got back.
So a theoretical loss on paper, but the real benefit was actually reducing the share count.
Precisely. The consequential result for you, the shareholder, was a non-cash repurchase of 8.0 million LAR shares.
Which is immediately accretive.
It is. It makes future earnings per share look better because you're dividing the same profit pie among fewer shares. It's a structural benefit, not a cash drain.
And speaking of structure, there was that major leadership change. The co-CEO and president, John, is retiring.
After 4 decades, a huge change.
And management explicitly said they're not hiring a replacement. That is a stunning signal.
It is, and it speaks volumes about where they see the future of the company. They're getting so heavily on the technology that drives their manufacturing model.
So instead of a new person, it's new tech.
Basically. They're leveraging their deep internal bench, elevating Jim Parker and David Grove to split operations, putting Greg McGuff in a new strategic role. They argued they can now run a shallower operational structure.
Because the tech is doing the work.
Because technology automates so much of the coordination that used to require high-level oversight, they are literally taking cost out of the executive suite.
Which ties right back into that efficiency theme.
It's all part of the same story.
Okay, so we've established the operational strength, fast, efficient, clean balance sheet. But if the machine is working so well, why was the forward guidance the thing that made the market just punish the stock?
Because the guidance signaled that the margin pain is not over. The short-term pain is extending into the new fiscal year.
What were the headwinds they cited?
Well, the ongoing macro stuff, but they specifically called out that 6-week government shutdown from October 1st to mid-November.
Right.
They said that disruption just further eroded consumer confidence and required even more incentives late in Q4, which puts pressure on Q1.
So what does that first quarter of 2026 actually look like then?
The guidance is conservative, and that's what spooked investors. For FQ1 2026, they guided home sales gross margin to a range of 15 to 16%.
15 to 16, wow.
Now, management was quick to explain that Q1 is historically their lightest quarter. When you deliver fewer homes, you lose what they call field leverage.
Meaning you lose the cost benefits of running a full factory line.
Exactly. So they are positioning Q1 to be the low point for the entire year.
It sounds like they're setting a very, very low bar for the start of the year. What about the production numbers?
Deliveries are projected between 17,000 and 18,000 homes, and the average sales price is expected to tick down slightly to between $365K and $375K.
Which reflects that continued incentive use.
Right. And for the full year, they're looking at about 85,000 deliveries, so modest 3% year-over-year growth.
You know, one of the most interesting bits of color from the call was management's optimism about policy.
Yeah.
They seem to think Washington might step in.
They absolutely did. They reported direct engagement with federal officials, saying the government is intensely focused on the national housing crisis.
So their thesis is that housing is about to become a central element in addressing affordability.
Exactly. They are suggesting there's potential for major policy action or programs to help buyers in 2026. That's a very interesting, bullish catalyst they're banking on.
Okay, let's pivot back to the investor. I mean, the market reaction proves that traders are just laser focused on that near-term margin reset.
That 15 to 16% number.
That low point for Q1.
That's right. That number was the headline disappointment. It completely obscured the strategic positioning, the operational excellence we just talked about.
So the question for investors is, are you buying a short-term margin contraction or a long-term efficiency machine?
That's the whole debate. Management is arguing the company is structurally leveraged to the upside on margin.
So how quickly could that profit snap back?
Potentially very quickly. They've already done the hard work, reducing costs, optimizing the line. The only thing depressing their margin is that huge 14% incentive package.
So if rates or policy change?
If anything stabilizes demand, allowing those incentives to drop back toward that normal 4 to 6% range, the margin immediately snaps back. They don't have to rebuild the machine. They just need to reduce the subsidy.
But unfortunately for current holders, that uncertainty has meant serious underperformance.
It has. LAR stock has underperformed the S&P 500, even the broader homebuilders ETF, the XHB, across all recent time horizons.
The market is just waiting for proof.
Waiting for proof that the company has finally hit the profitability floor. Until they can prove they can cut those incentives without killing volume, the stock's going to trade under pressure.
It's a stock trading on hope. Hope that 14% is the ceiling of the pain, not the new normal.
Exactly. Okay, so for our final segment, where we pitch an aggressive but plausible trade idea based on this analysis.
And we must say this is not financial advice.
Definitely not. But it highlights the opportunity that can emerge when operational reality diverges so sharply from market panic.
Right. Give us the thesis, the trade, and the justification.
The thesis is that the market is massively overreacting to the temporary, seasonally low Q1 margin guidance of 15 to 16%.
And it's ignoring what?
It's ignoring the structural advantages LAR has built. The 2.2x inventory turn, the 98% controlled land, the reduced costs. This whole platform is perfectly positioned to capture any unexpected upside.
From rates normalizing or?
Or, critically, from those federal affordability programs that management is explicitly anticipating.
Okay, so what's the trade?
The trade is a tactical long position in LAR stock, but you couple it with a small strategic short position in the XHB homebuilders ETF. It's a relative value bet.
Interesting. So why short the XHB if we're bullish on a housing recovery?
You hedge because the XHB, the whole index, has seen pretty robust gains recently, about 3.73% over the last month. The sector is arguably a little frothy and it's highly rate sensitive.
So the short XHB is just a defensive hedge.
It's a defensive hedge against sector-wide downside if the macro gets worse. But we are specifically betting that LAR's hyper-efficient model and its asset-light balance sheet will let it outperform its peers when the margin compression floor is finally hit.
So you're betting on the machine, not just the market tide.
We are betting on their specific machine, capitalizing on its mispriced operating leverage faster than the rest of the index.
That is a sharp focus thesis.
Yeah.
Betting that Q1 is truly the bottom and that operational superiority wins out.
It requires conviction in their vision and their ability to pull back those incentives the second the environment allows.
So let's summarize the core conflict from this LAR Q4 call. Management drove incredible efficiency and volume. They built this fast production machine with a clean balance sheet.
But they paid a historically high price for that volume.
In the form of deep incentives that pushed gross margin down to 17.0%, which spooked the market immediately.
It's a classic case of short-term pain for long-term gain, but right now, the short-term pain is dominating the whole story.
The investor focus is locked on that margin number,
Waiting for that incentive floor to be definitively proven.
which brings us to our final provocative thought for you to consider. Management noted that policymakers are trying to enact change while carefully considering unintended negative consequences.
Right.
So, given how sensitive the housing ecosystem is, and assuming a major federal affordability initiative does land in 2026, what's the most likely unintended negative consequence of that policy?
Could it just be driving up the cost of labor and materials, completely defeating the entire affordability goal?
That's something to mull over as you digest this deep dive. Thank you for diving deep with us.
We'll catch you on the next deep dive.